Hello, folks. This is Raj Sastry from Raja Option Trading. Today, we will talk about one of my favorite companies. It's called Snowflake, ticker symbol SNOW. It sells cloud computing technology for storing and analyzing data. It's a recent IPO, just started late last year, and it's got a legendary CEO, Frank Slootman. He's a ex chairman and CEO of ServiceNow, and under his leadership, ServiceNow did tremendously good. So I'm assuming even Snowflake will do very well under Mr. Slutman's leadership. And it's got some lockup expirations where insiders are allowed to sell stock. So something to watch out for. Sometimes in November timeframe, it had some insiders selling due to lockup expiration back on January 7th. And few highlights from earning call. The product revenue is growing 115% year over year, and net revenue retention rate is 162%. And CEO is very optimistic about improving the cash flow as well as operating efficiency. And it's basically, its customers are Fortune 500 companies. It's got a lot of new companies, and it's adding more and more companies as their customers. And some key customers, as you can see here, is Amazon, Adobe, Capital One, Coupa, HubSpot, and on and on. So it's a really great story to see how Snowflake can attract these Fortune 500 customers and retain them. And few key highlights from the earnings call. Earnings just happened back in December 2nd, and they beat the revenue estimates by 150 by 11.98 million. It's a 118% increase year over year. And from an EPS perspective, I think they did surprise on the downside, because it's really still not making profit. And because there is a EPS surprise, which is negative surprise on the earnings day, which is December 2nd, stock fell down by 3.7%. So with that, let's look at Snowflake here. As of January 15th, stock price is $291. Market cap is 82.46 billion. It's one of the bigger big data companies. And profit margin, as you can see, is negative because it's still investing heavily in building the product, and revenue is increasing, and they do have cash, and they have some debt, but not a whole lot of debt. And operating cash flow is negative. It's typical for a growing company. And 52 weeks range, even though it just started a couple of months ago, it had an impressive 14.72% increase in stock price. It had ups and downs, as you can see. And it's got some shares outstanding, and there will be more coming as the lockup expires in March. And a lot of institutions are holding this stock, as you can see here, 96.59, very impressive. And there is also a short float ratio. So there are some short people who are looking for shorting the stock. And CEO approval rate on Glassdoor is 92%. Very good for a company which is just IPO'd. And next earnings is March 3rd. So with that, let's look at historic performance on a monthly basis. Um, as you can see, October, this is when company started. For the month of October, it had a little bit down, 0.39%, and November, 30% increase. December, 13% decrease, mainly with the anticipation of lockup expiration, which allows insiders to sell its shares. And January, despite of lockup expiration, stock increased by 3.52%. And from a technical perspective, it's on a 20-day moving average. It's below 20-day moving average. It's improving. It's below 50-day moving average, and it's above 200-day moving average. So overall, on a longer term, it's doing well. on a shorter term, as you can see, it's taking some heat, in the shorter term. So with that, let's look at a quick chart of Snowflake. So if you look at the chart here, it's this is chart as of December 1st. It's doing pretty well. It IPO shot up out of the gate, and after that, it's kind of trading very well. It's got its ups and downs, as you can see, but really on a upward trajectory, as you can see. And right now, as of December 1st, it's hitting RSI. It's on the higher side of the RSI, relative strength index, and might come down a little bit. And on the implied volatility actually shot up around this time frame. Typically, that's the case when earnings are about to be announced. Given it's December 1st and December 2nd is the earnings. With that, let's go to next slide here. We talk about some option strategies for Snowflake. Snowflake, being such a volatile stock, it goes up and down, given in any given day. So how do we trade a stock like Snowflake? So our strategy is really, because stock is such a high flyer, let's bracket the stock, as we say it. So when you say bracket, what we mean is really in the shorter term time frame, for example, 23 days to expiration, we can sell some credit. In this case, we are selling a credit spread called credit spread, and it's a short term 15 delta. As we can see, we are selling it way above the stock price. Stock price is 307. We are selling at 415, and we are buying it back at 435. So we have a $20 exposure here. For $20 exposure, we are basically making a $1.55 credit. If the stock remains below 415, we get to keep our entire money. Otherwise, we have to adjust this position accordingly. So this is one play. Basically, we are selling a call credit spread way above the current stock price at 15 delta. Next strategy is, so with this, we are, like we talked about, we are bringing in $155, and there's a buying power effect. If negative buying power effect, it's 1845, and with that, let's go to the next one. So next is really one more short-term play. This is on the put side of the house now. Short-term delta 30, as you can see it. $20 wide spread, 280 and 260, and it's really much below the stock price. So the probability of the stock hitting this price, which is 280, is about as you can see here, 71%. But because stock price is at 306, we feel confident with our $20 risk exposure. So for this $20 risk exposure, we are collecting $7.10. As you can see, we are collecting more money because it's on the put side of the house. So let's go to the next slide here. This will kind of summarize. We are selling this for $7.10, a credit spread way below the current stock price, and for that, our buying power effect is $1,290, and max loss is $1,290. So kind of sums up the trade here. And next we'll go into one more short-term play here, and this is a call credit spread. As you can see, we are selling a delta 12 call way above the current stock price. Current stock price is 305. We are selling this $20 wide spread at 440. So because it's way above the stock price, we feel pretty confident that we'll probably make money. Even if we don't, we got a defined risk strategy. We have a just $20 exposure. So for this, we are collecting about $1.27. Let's fast forward. $1.27 we are collecting, and max risk is 1873. That's basically, we have a $20 wide spread. We are collecting 127. The remaining 1873 is our a risk that we have. That's the max loss. Unlike undefined risk where you outright sell a naked call, here it's a defined risk. We only have $20 risk. That's why max loss is 1873. Let's go to next strategy. Next strategy is again near term. As you can see here, 30 days. It's we are selling a short-term delta 29, as you can see here, actually a delta 29 put credit spread. It's again $20 wide. We are buying back 255, selling 275, and for this we are collecting $6.80 times 100. So let's sum that up. So we are collecting $680, and max loss is 13.20, because it's a $20 wide spreads. If you're collecting 680, the remaining portion of $20 is our max loss, which is 13.20, and buying power effect is 13.20, as you can see. So this is, I think it's going to be a very good trade here. Next trade, we'll look at a call credit spread 30 days out. So we are selling a 16 delta call, um, and buying back a 13 delta call here, which is 450. So for this $20 wide spread, we are getting a $1.25 credit. As you can see, on the put side, we are making way more money than the call side, because these stocks, they tend to go higher, but they also can go low very fast. That's why on the put side, you make more money here. To sum it up here, we are collecting $125 here, and our max exposure is 1875. That's because it's a $20 wide spread. We're collecting this much, and remaining portion of that $20 wide spread is our max loss. So with that, let's go to next option strategy for Snowflake. This is again shorter term, 38 days to expiration. We are selling a put credit spread. In this case, it's just a $20 wide credit spread. We are selling 275, and we are buying back 255 right here. So for that, we're getting bringing in $7.40. And to sum that up, we are bringing in $7.40. Our max loss is 1260. That's basically like we talked about, $20 wide exposure. We collected this much. Remaining portion will be your max loss. With that, let's go to next strategy here. Next strategy is again 45 days out, which is nearer term or short term. We are selling a delta, we are selling a delta 20 call and buying back a delta 17 call. So for this $20 wide call spread, we are bringing in $1.60, and just to sum that up here, we are bringing in $160. Our max loss is 1840. With that, let's go to our next option strategy here. Now we are looking at 45 days to expiration. Again, we are selling a put spread, 275, 255, $20 wide. We are selling a 30 delta call. It's a 31 delta call, bringing buying back a 22 delta call, and for that we're bringing in $6.75 credit. And with that, just to summarize, 675 max profit, 1325 max loss, and our buying per effect is 1325. And with that, let's go to next option strategy here. Same theme. It's 80 days to expiration now. So here we are doing a little bit different. So we are basically buying a mid-term in-out spread. In-out meaning we are buying a in-the-money call option here, which is 300 strike price, and we are selling a 350 strike price call option. So for if the stock goes up from 300 all the way to 350, we make money. So we are paying a $16.90 here debit, but So we have room to grow. This $16.90 debit that we pay, as the stock goes up and up and up and up, it can go all the way to $50. So we can basically sell it at $50. That will give us a very good margin from 16 to $50. So if the stock goes in the longer term, it's a very good strategy. And just to sum that up, our max profit here is much longer, much higher, as you can see. And um, we are max loss is 1690. That's money that we paid for this this debit spread. um, Normally, it's always, I like doing the long or buying the spreads many times with the educated guess, because this buying the spread, it can grow. For example, in this scenario, we paid $16.90, and we can make profit if the stock keeps going up. The spread expands from $16.90 all the way to $50. So that's the beauty of buying the call spreads versus selling debit credit spreads, where your money that you make is always limited and your max loss is much more. In here, max loss is 1690, whereas your max profit goes all the way as this spread expands to $50. So with that, next strategy here is buying a debit spread. Here we are buying a 350 put, and we are selling a 340 put. So for this debit spread, put debit spread way above the current stock price, it's actually, as you can see here, delta 57 that we are buying. So we are paying $7.60 for this $10 wide debit spread. So we expect to make around $2.40 profit if the stock falls. So with that, this is the quick summary here. We are um, break-even price, max profit, max loss is what we pay, and our max profit is 240. These two will combine. We'll get to the $10 wide spread that we talked about earlier. So next is a long-term in-out spread. So stock price is around 306. As you can see here, we are buying a $300 call, and we are selling a $350 call. So it's a $50 wide spread. Our direction is bullish here. We are assuming the stock will raise about 306, hopefully all the way about 350 by next 171 days. And with that, let's go to next. This will kind of summarize. So we are our max profit is 3316, and we paid 1640. Here again, it's a $50 wide spread, so spread will expand as the stock price goes up. This will kind of summarize, even though we placed a lot of trades, some of the trades did not go through in time. So these are the trades that got filled. So we have put credit spreads, which are nearer term, as you can see, 23, 30, 38, 45. So here we collected money, as you can see here. We collected $5.50. In this vertical here, we collected um, okay, right here. So here are the trade price for these $7.10, $6.80. This is the money that we collected for selling the put credit spreads. And now we also sold some call debit spreads. So if you see here, we got a call debit spread, and we paid $17.40. It's a $50 wide spread. It can expand further, and we can make money as share price increases. And we got a put debit spread here. And this put debit spread, we paid $7.55. It can grow to $10 wide. We can make around $2.45 profit if stock falls. And we got a call debit spread here, 300, and it's actually called debit spread in our spread. So if the stock price moves, from current price, we can gain to profit. We paid $16.40. We got room to grow till this reaches $50. So it's a good room to grow. This is a summary of all the trades that we have done, and now we'll go into first expiration date. Right now, December 24th. So this is expiring. This first put option, which is credit spread we sold, is expiring, and we are making $710, which is a good trade, mainly because the Snowflake traded sideways. So because of that, we could make money, and stock is still above the our 260 put, 280 put that we sold. Stock is at 327, as you can see. With that, next expiration is December 31st. The credit spread that we sold is expiring, and we're collecting $6.80, which is a good trade, mainly because stock is at 293 here. Our short put that we sold is at 275, so that's why, because it's above, because it's below the current stock price, we still made money. Next one is really one more put spread. Again, it's a short put credit spread. Here also we made $737.50, mainly because stock price now is 308, but we sold 275 put spread. Next is um, a short put credit spread. It's expiring in 1 day, as you can see here, and here also we made $1,935, which is a good move here. And as you can see, we got a couple of more things going on. We got a call spread here, which is a debit spread. Here we lost 165 as of now. We got 36 more days to go. If Snowflake goes above, right now it's at 304. As Snowflake raises in stock price, we will make this money back. And we got one more put spread here, which is a debit spread. We wanted stock to fall. Here we made $35. If the stock falls, we'll make more money on this. And we got one more bullish in-out spread here, 300, 350. So here we are making $15. As stock price increases, we will again gain make more money here. So that's the quick summary of the trades that we have done. So in a nutshell, for a stock like Snowflake, which is very goes up and down, very volatile, we can basically sell call credit spreads, maybe around 15 delta or so, way above current stock price. You can go for a $20 wide spread or something along those lines. And you can also sell some put credit spreads, maybe 30 delta. In our case, we did a $20 wide spread, way below current stock price. You can do it for a shorter term, both of these credit spreads. And you can gain from stock trading sideways. And because Snowflake also fluctuates and moves rapidly on the higher side at times, you can sell in-out spreads a little bit longer term. Sell a call below the current stock price, and buy a call below the stock price, sell a call above stock price. We kind of went with the $50 wide spread. This will allow us to grow with the stocks increase in price. And we also did some put spreads, which is longer term. So in case stock falls, we can benefit by these put spreads that we are buying. So that's in a nutshell, a strategy for volatile stock like Snowflake. And same strategy will apply to other volatile stocks like Shopify, Tesla, and many other volatile stocks, including C3.AI or AI as we call it. Thank you very much. Hope this helps. Happy trading.